Welcome to Cryptocurrencies, the Rise of Digital Money show, and I'm very happy to have with me Craig Cobb, Trader Cobb, who is one of the best crypto traders around. And we're going to talk a little bit about technical analysis, what's going on in the space, and everything that's going on in 2019 as compared to 2018 and 2017. Just a really good guy and really honest, and he's going to be brutally honest, I imagine. And I'm really happy to have him on the show. Craig, thank you for joining us.
Matt, it's an absolute pleasure. Thank you for having me on the show.
Well, I wanted to really dive in with you on what's going on, the changes that are going on behind the scenes. So if you only look at the charts and you only look at the coinmarketcap.com, you don't see the real picture and what's going on behind the scenes with many of the crypto projects. Obviously, a huge year down for all of them. No one is excluded from this massive bear market. But we've had 5 and 6 of these before where it's going down 80%. Doesn't mean it's the end. They always look for a new identity, a new bid, and obviously making some fundamental progress in order to really become important to the financial system. Now, obviously, ICOs were obliterated in 2018, just 90% of them going back to zero, and we saw an insane amount of companies and startups fail. And I mentioned this throughout 2018, that ICOs are basically startup companies, very, very risky, ultimate rate of failure. You can't get any riskier than that. And I know you talked about yourself the move from ICOs to STOs. So can you talk about a little bit what is an STO, and are there ways to invest in them? What are people doing? And just inform our listeners of what is an STO as compared to an ICO.
Yeah, sure, mate. I mean, look, the ICO madness last year, you hit the nail on the head. They're literally a startup, and a startup has a very high rate of failure. The issue with startups with the ICO was that you weren't actually buying any equity in the startup. You were literally just investing into the token. And many of these operators during that hype cycle, which was ended December, early January of 2017 and then 18, that little 2-month, 3-month corridor there, we saw a huge amount of projects come to ICO, raise a lot of money, and this year they have since vanished. Now, often those projects were never very good in the first place. It was a lot of unsophisticated investors that were pouring their money into these projects, and from sort of September leading up to December, January, there was a lot of people doing very, very well. This kind of fueled the fire, and often companies that only should have probably been after $500,000 were getting 30, 40 million, and it kind of got a bit out of control. So the pullback has hurt a lot of people. It's also taught them a lot of lessons, and I think that's the most important thing to take from this for people that have been hurt within that ecosystem, is that they're here. It's got them there. They've taken a burn. We've all had that happen. It's how I started. You've had losses. I've had bad losses. It's typically a great place to learn. So I just hope people can learn from that. Now, what stemmed from that is that the ICO market has become a little bit of it's become a bit stale. It's not a market where people are as excited to talk about. It's become much more difficult for projects to raise. And what that's done is it's brought the cream to rise to the top. Good projects can still raise money, but they need to be very, very good. From there's been a lot of talk throughout the year of the STO market, which is the security token offering. So security tokens are basically categorized by securities law. Therefore, they do fall under a set of rules, and therefore there's less of that gray area around, is it going to be regulated? Is it not? What's going to happen? What's it going to look like? Because they're working as a security, basically. Now, the security token market, one of the areas that I see a lot of potential is the, property market, your REITs, REITs, and the reason behind it is, even like smaller developers, like not necessarily an REIT, but they could raise capital for their developments, which would be very, very happy for them, rather than going through the banks, which I think lending is starting to get more and more tight. Certainly in Australia, I know that interest rates have been falling and slowly starting to raise, but banks have been really holding back on allowing people to borrow. So what it can do is it can create a new marketplace where, if there's a apartment in New York, a block of apartments, and let's say the penthouse is, $100 million, well, there's only a certain amount of people that can invest in that. They can't really, unless you're in the mega wealthy, you can't have that as part of your portfolio. Now imagine if they tokenized that and made that, let's say they made it, 100 million tokens for that particular apartment, and you could buy 10 tokens, 20 tokens, or whatever it may be. You can then invest your money into high-end real estate through the security token and diversify a portfolio of global properties all around the world without having to be worth tens or hundreds of millions. So it's a really good option for companies like that and beyond. Everything can be tokenized, and security tokens appear at this stage to be a work in progress. It's definitely worthwhile keeping an eye on.
Definitely. I think it's important what you raised, that point with security token offerings. And you basically can make any asset sort of liquid as a public company. So if you take a block of apartments or a mall, a large condominium, yes, it's really a very interesting phenomenon, because you can make micro investments into asset classes that usually accredited investors or just high-end people would be able to, only them will be able to fund the project if it's very early stage, or to own the project if it's in its finished stages. And it opens the field up for many other people, and that's very good. It's leveling the playing field, which is what crypto is all about. And I want to ask you, you're a charts guy, and you really focus on technical analysis. But before we dive into that, and we are gonna showcase some of these very reliable signals that you work with. Can you explain to people a little bit of the concept of tokenization, because it's going to be very big in 2019? Companies that are going to have their own blockchain economy and their own coin for obviously backed by the dollar, backed by something. To make it more smooth and less volatile. So can you explain the concept of tokenization?
Yeah, I mean, I can make it pretty straightforward so I don't go into the complex tech side of things, but effectively what it allows people to do is, what it allows business to do is monitor things better. If you control the currency for which your products are purchased, then you also know how much currency is available. You know where that currency lives. And if people have that currency and they're only going to be spending it on your products, you can start to work out a little bit about what the ecosystem looks like and how you can feed those types of, feed your business back better and plan the future better. So from a business point of view, purely, it's almost like, depending on how companies want to use this, they can look at it like a coupon code. How there were coupons in the papers, your grandma would go through the magazines and cut out all the coupons. The problem is you can't track coupons. You don't know who has how many and how they're going to use them and what they're going to use. And coupons are effectively free. So if there was a form of currency or a form of token, however you want to call it, for something like I think American, like something like a Starbucks, for example, or even in airports. Airports can have their own form of currency where you don't need a wallet. It's there as an app on your phone, and you just walk around with your phone or something else and you tap away. It's going to help people in business to understand what's going on. They can also give rewards and whatnot. Now, as far as that's from a token point of view. As far as the liquidity providing aspect, which is what we sort of just briefly touched on, as we said, big real estate deals, things like art that we can't access unless you've got mega wealth. These are very illiquid assets. They are assets. There's no doubt about art. It's an asset class. There's no doubt about high-end cars. They're an asset class too. But they're just there for the super wealthy. If we can bring in the general public, well, then these items should, given that the market has grown outside of just purely wealthy people to the whole planet, should see these things increase in value, and therefore the world's wealth, not just the big guys and girls, the little guy can also benefit from that as well. So there's a few ways of looking at how tokenization can change the way that we operate on this planet. Where it goes to and when it happens, well, that remains to be seen.
Well, there's definitely lots of acceptance of new products because, as opposed to baby boomers who are all in on stocks, like half of that generation has a stock portfolio, even more, and they hold a lot of the world's cash. As compared to them, millennials who are plugged with, with student debt and revolving credit card debt and everything like that, they're not really big on the stock market, and they're open to, obviously, to new ways of investing. Before we dive into technical analysis, Bakkt just announced that it's going to get delayed from January 24th. Any thoughts on this delay, and do you think it's going to be prolonged, or just in general, how will it affect prices or the market, or do you think it's already priced in?
Oh, look, I think after all the ETF, pushback, I think the market's kind of learnt to take every date, as a grain of salt, not take it too seriously. Everything gets pushed back. I don't see it as a problem. I mean, short term, it hasn't done anything to prices right now. It's really not affected anything. We continue to just consolidate between 43.85 and 36.76. And, it's good to see. It shows a bit more of a mature market. Gone are the days where somebody talks about something in a positive light and the market shoots up $1 billion or goes down $1 billion if it's a negative thing. It seems to be that we've consolidated somewhat. We understand the market a little bit more. The participants aren't quite so sketchy, so flighty is probably the right word. Bakkt will be very, very good when it comes. The ETF. I think Bakkt has probably got a little bit more value to it because they'll be settling in Bitcoin, whereas the ETF, I don't know if they will be. But these are all positive things. As big corporations are coming into the space, they just raised $182 million for Bakkt. So as big companies come into the space, it brings with it a level of legitimacy. People sort of associate brands with how legitimate a market is, and these are good things for the ecosystem, short, medium, and long term. Well, probably medium to long term. Short term, as they keep pushing things back, well, we just have to put up with that.
Now let's move on to technical analysis. Okay, so one of the terms that a lot of people are very excited about. It's called cradle zone. So can you talk a little bit about what that means for technical investors, and why is it even beneficial to get invested in cryptocurrencies using technical analysis instead of fundamental analysis? Because obviously, for me, cryptocurrencies have always been primarily a technical analysis tool, because the fundamentals are just so... Yes. So let's talk a little bit about what is the cradle zone technical analysis and why it's good for crypto investors to get educated on these subjects.
Yeah, absolutely. Look, when it comes to trading and investing, there's two ways of doing it. You got your fundamental. I had these conversations at different events in London. I've been trading for 13 years, and I used to do a lot of the expos over there in London and Europe. And you'll have your old school that sort of sit there with their monocle hanging off and a walking stick and their tweed jacket, sort of saying, "Oh, technical analysis doesn't work, old chap. It's only fundamentals that work." And you're like, "Okay, granddad, no dramas. If that works for you, then high five. Good man. You've got this. Well done. You've done well." But I'm using technicals and I'm doing well as well. So there are two schools of thought. For me, I prefer to focus on what I'm good at, what I've been doing for a long time, and that is technicals. Now, the cradle zone is, for me, something that I've created that is around an equilibrium. Now, whether you're investing long term or trading short term, you want to have a fair value price at which you purchase. Now, whether that be a purchase on the upside or whether you're shorting, you need to have a fair value. Now, the equilibrium point that I look for, depending on each time frame that I trade, because it's applicable to any market and any time frame, is I use the 10-period exponential moving average. So that's the 10 EMA and the 20 EMA. Now, if any of your listeners right now want to go and put in the 10 EMA and the 20 EMA onto a chart and look at a period on any time frame that they like, when it's trending, you'll see what I mean. It pulls back. Markets move in cycles. We know this. We do see trends form. Now, this is an opportunity for people to learn about at what point do I become interested in buying or selling a particular asset class, whether I go long or short. And the cradle zone is one of the ingredients that I use for my trading strategy. So my trading strategies, there are three based around the markets going up, pulling back and pausing, going up, pulling back and bouncing fast. And when I say up, I'm just using the bullish example. It goes both ways. Markets also consolidate. And so I've got a breakout trade as well. I've perfected these over basically 13 years. I haven't changed them for the last 8 years. Not even close. I've not changed a single thing about them in 8 years, and I've applied them to all different types of markets. But you just got to know, you just got to have a point at which you're interested. And that cradle zone really helps me with that. It's a big part of what I do.
So that's very interesting because basically it's another way of saying that you're looking for whether or not you can have a nice gouge of the edge of profitability, or where profitability becomes more favorable to your advantage. And it's basically like what we have in the stock market, where we have a watch list. You have a list of companies that you're watching, and you know at what price you're looking to get in. You either do it through PE multiples, or their cash flow, or peer group analysis, etc. You just have this idea, this range, to where you say, okay, if this stock trades for this much, it becomes interesting, and unless it does, I don't want to spend energy and time on it because it's just too expensive and it's just not worth the investment. And I totally get the cradle zone. It's a great it's a great term. Now I want to ask you about convergence and divergence. Exactly what is that?
Yeah, so again, like coming into, you were talking about a watch list before, so things pull back to a certain price and you're happy, yada yada. I mean, look, at the end of the day, I think that people that are investing or trading, they tend to be the successful ones have a process of elimination as opposed to looking for trade. So when I go to the market, I'm not looking to take a trade. I'm looking at the market, and if it comes to me and fits my checklist rules, great, I'll take a trade. But I'm not trying to find a trade. I'm eliminating everything. Now, for me, convergence and divergence, that's one of my elimination pointers. So if you consider, if in a trend you have a higher high in the trend, but the MACD, so moving average convergence divergence, it's an indicator that you can have on your chart. I use it 12, 26, and 9. It's just straight out of the box. What that does for me is if price is making higher highs and my MACD is making higher highs, then these two are in agreement. They're converging. Now, if I have a price where it's making higher highs, but the MACD is making a lower high, obviously it's not agreeing. Price and MACD are not agreeing. This is divergent. Now, this is an indicator for me to understand when possibly, because it doesn't always work, when possibly momentum is starting to slide from that particular market, and it will keep me out of a trade. So everything I do is about looking for reasons not to take a trade. The MACD, moving average convergence and divergence, using that as for convergence or divergence with price, it really makes a huge difference, and it allows me to leave a lot of trades that would have turned out to have been a losing trade. And I use it across all my trading strategies, same as the cradle zone. They're the two indicators that I use.
So that's very interesting, and obviously I'm aware of the MACDs, and it's just a very good layer of understanding whether or not there's a nice bid out there, or if the price is moving forward on basically low volume, or just fundamentals that are, or not fundamental, but technical momentum that is false, or indicating a false move. So it's a very important factor, and obviously I like the way that you approach this process altogether by saying let the market come to you, let opportunities come to you. Don't fall in love with looking for opportunities, but do the opposite. Sit down and just wait and be patient. And it goes back to Warren Buffett, that talks a lot about the fact that you don't need to bet. This is not a baseball game where somebody throws the ball at you, and if you don't bat it for a number of times, you're striked out. You can have somebody throw any ball at you forever, and if you don't want to swing, you don't swing. It's a great analogy for saying you can just sit, wait until the money's on the floor, and then pick it up, like Jim Rogers says. I want to ask you about moving on with this theme. I want to ask you about stuff to avoid altogether. When you see a chart that looks in a particular fashion, you're saying this is a big no-no. This is like a red flag. I don't want to get involved. I don't want to even keep digging and looking. I've had enough. What are some charts to avoid?
So one of the big things about trading and investing, of course, is always to manage your risk at all times. Now, the thing is that people often just pay that lip service and don't truly understand where risk comes from. So risk comes from a couple of areas. Just because you've gone and said, like, let's say entry goes here, stop goes here, and I'm going to risk $1,000 on this trade. Just because you've put the $1,000 in and nominated your exit and entry point doesn't mean you're going to get that exit and entry point. Because if it's an illiquid stock or an illiquid token or currency or whatever it may be, then there's a potential you'll get slippage, which means you might say, I want to exit at 500 for $1,000 loss. You get exited at 495 for a $1,250 loss. That's additional risk that you hadn't sort of accounted for. So how do you avoid these types of risky circumstances? Well, it comes down to how you read a chart and what charts you trade. So I can talk about it primarily from a trading point of view because you need to be specific with your entries and stop losses, and that's essentially why TraderCobb.com's around, to help people to understand what they are. But effectively, if you're trading a chart that is gappy, okay, so I guess without having a visual to show, the best way to explain gappy is that if it's not a smooth, flowing, trending chart, that's a smooth, flowing, trending chart, leave it alone. So if there's big gaps in price, so it jumps from $4 to $4.10, and then there's no trading in the middle of that. If it looks chunky and messy, then it's probably one to avoid. So looking for those smooth, flowing, clean, trending charts really does eliminate a lot of cryptos and a lot of smaller cap charts of other companies as well. And just by doing that, you are eliminating some of the slippage risk to your trading or investing. And I think that, that's a big area that a lot of people overlook, because often people focus too much on the strategy itself, like where do I buy, where do I sell? And they don't work on the finer details that still carry significant risk. The other big one of risk is yourself. If you don't feel good, you shouldn't be trading.
I think you really touched an important point that I obsess about a lot, and it's risk. It just is the most important word in investing, to be cautious. Yes, really understanding risk and understanding what creates risk, like you said. And there's so many misconceptions regarding risk, like saying the riskiest stocks have the highest potential. Well, if that was true, they wouldn't be risky because they have the highest potential. So many misnomers regarding this process of risk and how to evaluate it and where it comes from. And I think it's just very important to study risk and obsess about risk and not obsess about profits. If you obsess about risks, you're going to have a long-term career in investing, and if you have and the profits will definitely come once your level just goes up because you're obsessing about the right things. Craig, I wanna finish off with asking you, where can people follow your work? Do you have social media accounts, or do you have another platform that people can check you out and really get to know about what you're doing over there in Trader Cobb?
Sure. Look, you can basically just chuck it into Google. You'll find me on Facebook, Trader Cobb account, and also Craig Cobb. Cobb, by the way, is C-O-B-B for Bravo, so it's Trader C-O-B-B. You can find me on Facebook. You can find me on Twitter, YouTube, all over the place. We do an enormous amount of free content, so there's really no excuse for not working out what we do and how we do it, to see if there's any interest there as to learn from us. We also have the podcast, the Trader Cobb Crypto Show, where I've obviously interviewed you, Lior, and plenty of other people within the space. So if you want to get your daily dose of interviews and market content, then jump across there. But realistically, the best place to get the information that you need is going to be at tradercobb.com. You can join up there to a free bi-weekly video newsletter, but just go through the new website, have a look at it all. We've just updated it. A couple of things we're still working on, but it'll take you through. You get a good understanding of what we do. Bunch of people in there with testimonials, whatnot. We pretty much make it easy for you to make a decision whether or not you like what we do and you think it will benefit you or not. And that's the whole point of it.
Craig, you're a good man, and I think you're very honest and talk about the markets in a very smart and wise way. And glad you were with us, and we'll definitely circle back during 2019 to get your update on what's going on at the pulse of the crypto market.
Love it, mate. I appreciate your time, and thanks to the audience for having a listen.